It's Wednesday, the 1st of September 2021. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Sean Aylmer. Earnings season ends with the share market up for an 11th consecutive month. That hasn't happened since 1943, and that's our main story. Also coming up in today's podcast, business leaders combine to ask for a way out of lockdown as Australia accesses an extra 500,000 Pfizer doses. Fears that a slump will hit the building construction sector in coming months, and the superannuation regulator outs the worst performing funds. Then stay listening for my chat to Clayton Howes, boss of MoneyMe, about the consumer finance sector. But first, here's a brief look at markets. Wall Street was slightly lower overnight, but was heading towards a seventh successive monthly rise. Supporting the market was the National Home Price Index, which rose more than 18% for the year to June, the biggest rise in 30 years. In early afternoon trading, the S&P 500, the Dow Jones Industrial Average and the Nasdaq were all down 0.1%. European markets were weaker on fears that the European Central Bank might start tapering monetary policy later this year. London's FTSE was off 0.4%, while the Stoxx Europe 500 ended down 0.6%. Most markets in that region ended up for the month of August. The local market is part of the main story, more of that shortly. Oil prices were down overnight. The price of gold was a touch higher, and the Aussie dollar is trading at just a bit over 73 US cents. One of the most contradictory earnings seasons on the stock market ended yesterday, completing 4 weeks of record profits, bumper dividends and some very wary outlook statements. The S&P ASX 200 closed yesterday up 0.4% to 7,535 points, marking 11 months of consecutive gains. That hasn't happened since 1943. Ironically, the biggest winners in earnings season, the three iron ore miners, BHP, Rio Tinto and Fortescue Metals, which announced a combined $65 billion in profits and record dividend payouts, were among the worst performers during the month. In their cases, the price of iron ore tumbled after China capped steel-making production, triggering a drop in their stocks. The share prices of consumer discretionary stocks, such as JB Hi-Fi, Domino's Pizza, and many other retailers, performed well into the earnings season, and many of them announced record profits. But CEOs were very cautious about trading conditions this half year, and their share prices lagged during the past few weeks. Commonwealth Bank reported half-year earnings, while the other three major banks reported quarterly cash profit. All were strong. The energy companies announced major write-downs and continue to struggle. Merger activity in the oil and gas sector overshadowed mixed results. Wesfarmers was the standout retailer. Technology and healthcare stocks announced a mixed bunch of results, with US payment system group Square's $39 billion bid for Afterpay dominating that sector. According to AMP Capital's Shane Oliver, around 40% of results surprised on the upside, a touch below the normal level, but only 18% surprised on the downside, which was below normal levels. 3/4 of companies grew earnings, while 9 in 10 maintained or upped their dividends. There were around $30 billion in dividend payments announced and $20 billion in buybacks. They're big numbers. So, what do we now know that we didn't know a month ago? We know that we don't know as much as we thought we did. COVID-induced lockdowns, which kicked in immediately after the last financial year ended, has cast a shadow over earnings this financial year. The pace of vaccinations and reopening is critical. As Dr. Oliver predicts, the share market in the short term could be in for a bumpy ride. In a moment, the rest of the news you need to know this morning. In overseas news, Israel has been a poster child for vaccinations, but yesterday recorded 11,000 infections, its highest daily number ever. The government has encouraged all citizens to get a third jab of the Pfizer-BioNTech vaccine. In the US, President Joe Biden said lockdowns had contributed to the deaths of more than 93,000 Americans from drug overdoses, highlighting the hidden costs of the virus. The United States is no longer in Afghanistan, and the Taliban overnight celebrated its independence and took control of Kabul airport. A Taliban spokesperson said the US had been defeated and Afghanistan was now a free and sovereign nation again. In the final few weeks, 120,000 civilians left the country, though some are still stranded there. And South Korea has become the first country to force Apple and Google to open up their app stores to other payment systems. App Store operators will be banned from forcing developers to use their online payment systems. This is particularly relevant in Australia, where the Commonwealth Bank has complained to Parliament about Apple preventing access to its iChip and has called for an opening up of the group's payment system. Locally, more than 80 business leaders, including the heads of the big banks, miners, retailers, insurance groups and property companies, have put their names to a letter calling on state leaders to stick to the national plan out of lockdowns. The CEOs, which represent more than 1 million workers, said it was important to give people a light at the end of the tunnel, and the current national plan struck the right balance between keeping people safe and the economy. But Western Australia Premier Mark McGowan and Queensland Premier Anastasia Palaszczuk continue to push for zero COVID transmissions, which is something New South Wales and possibly Victoria won't be able to achieve. Reopening of borders and the national economy will depend on all premiers agreeing to the national plan, which doesn't include zero cases. It came as Prime Minister Scott Morrison said 500,000 extra doses of the Pfizer vaccine will be available this month after a deal with the Singaporean government. The city-state is now largely vaccinated and will take 500,000 doses earmarked for Australia due in December. Meanwhile, New South Wales reported 1,164 cases of COVID-19 yesterday and 3 deaths. A report from the state's health department shows that more than 80% of people who contract the virus are not vaccinated, while 9% have received one jab. The state will also reduce the intake of returning overseas travellers to 750 per week from next month. Victoria yesterday recorded its first 2 deaths from COVID-19 this year, both women, one in her 40s and the other in her 60s. The state recorded 76 new infections, and Premier Daniel Andrews said he would consider some modest personal freedoms if a lid can be kept on cases. The pace of growth in house prices has slowed from their March peaks, but at least they're still rising. Worsening housing affordability is to blame, economists said. For the month of August, prices were up 1.8% in Sydney, taking the increase so far this year to nearly 20%. In Melbourne, the prices were up 1.2%, taking the 2021 increase to more than 12%, according to CoreLogic. Brisbane and Adelaide both posted monthly gains of 2% and have risen by 16% and 13% respectively this year. There are signs that the home construction sector could stumble in coming months after building approvals fell by nearly 6% during July and were 33% below their peak in March. The biggest drop came in approvals for units, which were down 12%. The latest run of figures reflects the end of the home builder subsidy, which brought approvals forward. Private house approvals remain high, but the data shows people aren't going through the council to get renovations and constructions done like they were a few months ago. And that could, and probably will, hurt the home building sector later this year and into next year. The other piece of Bureau statistics data out yesterday was a record $20.5 billion current account surplus during the June quarter, off the back of strong bulk commodity prices, particularly iron ore. We know that story well. The figures will feed into June quarter economic growth figures due for release today. The consensus forecast is for a slight positive for economic growth, which would probably mean the economy and federal government avoids the ignominy of a double-dip recession. The superannuation regulator yesterday released its inaugural performance test results for the sector, and 13 funds failed, including the Commonwealth Bank's in-house super product for employees and the industry fund for Victorian independent school employees. Colonial First State and BT also had products that were underperforming. The ratings by the Australian Prudential Regulation Authority have been controversial from the get-go and are designed to improve transparency in the sector. The underperforming funds will have to send a letter to the 1.1 million members affected, telling them their super is in a product that has performed poorly. There's some good news today. Total emissions from Australia fell by 5.3% for the year to the end of March. The bad news is that much of it was attributed to the economic hit from COVID-19, and in all likelihood, emissions will surge again. That's according to the latest quarterly report from the Australian Greenhouse Gas Inventory. Transport provided the biggest reduction thanks to falls in petrol consumption and aviation fuel. The figures show that when lockdowns ended late last year and early this year, emissions creeped up again. Transport makes up 17.5% of Australia's carbon footprint, while the electricity sector comprises 33%. Harvey Norman said earnings last financial year jumped 75%, but the retailer cut its dividend, saying the next few months looked uncertain. Chair Jerry Harvey said the group was cutting back on marketing to preserve cash as lockdowns hit sales at stores in Australia and New Zealand. But the group will repay JobKeeper payments it received. Mr. Harvey was more circumspect yesterday than last year in the early stages of the pandemic, when he was roundly criticised for suggesting his business would do well from COVID. He turned out to be right. Harvey Norman's share price fell more than 3% yesterday. I mentioned that Fortescue's Andrew Forrest had pocketed more than $4 billion in dividends last financial year. He wants to spend some of it on a Canadian nickel explorer, Noront Resources, and has trumped a competing offer for the business by BHP. It just demonstrates the popularity of mining companies likely to benefit in a decarbonised world. Along the same lines, Sandfire Resources said it's ready to build a new copper mine in Botswana and replace its ageing DeGrussa operations in Western Australia. The comments came after the group reported record profit, revenue and dividends on the back of higher copper prices. Mesoblast share price fell nearly 16% yesterday after it announced a widening of its annual loss, and the US Food and Drug Administration raised questions about its flagship drug candidate. The drug aims to treat acute respiratory distress syndrome in adults with COVID-19, but the FDA wants Mesoblast to improve its consistency when manufacturing the drug. The share price of this company has been on a crazy ride. 12 months ago, it was more than $5. It's now less than a third of that price. Aussie Post has delivered, pardon the pun, an annual profit of more than $100 million off the back of record revenue. E-commerce is good for Australia Post. But Acting Chief Executive Rodney Boys said lockdowns are putting significant strain on supply chains and the transport of essential goods. Stationery retailer kikki.K has collapsed for the second time in 12 months, with its co-founders telling staff it was going into voluntary administration. It was rescued from that fate just 12 months ago. The boss of Shaver Shop said he was upbeat about a sales rebound once lockdowns end, confident that the COVID-inspired long hair craze will end. Chief Executive Cameron Fox said that like last time there was a hard lockdown, online sales boomed in weeks 5 and 6, when people realised they couldn't go to the hairdresser, or in my case, barber. The group announced a big jump in profit last financial year, though has found it much tougher since. And finally, the AFL Grand Final will be played in Perth this year as a result of Melbourne's lockdown. It will be only the third time the game won't be played at the MCG. It was at the Gabba last year and Waverley Park back in 1991. Don't go away, because up next is our daily interview. My guest today is Clayton Howes, the founder of ASX-listed lender MoneyMe. MoneyMe is a fintech taking on the big banks in the world of consumer lending, and it's growing quickly. That's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. It's Wednesday, the 1st of September, 2021. It's going to be a good spring and a great summer. I'm Sean Aylmer, and that was Fear and Greed. Enjoy your day.